You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 20th of May, 2023, and I'm rejoined by our special guest, Bennett, who is at value_1pages on Twitter. So Ben has just done a 1 hour episode with us. Well, it's probably going to be about an hour once I've edited it, that focuses on his general investing philosophy and how he became interested in investing. And in this episode, we're just going to break down his actual portfolio and some of the stocks in it. So firstly, Ben, thank you very much for coming back on the show. I know it is the same day, but thank you very much for your time because it's a lovely day. I'm sure there's plenty of other places you could be rather than sat inside talking to me. So thank you for your time.
It's now cleaning the kitchen or somewhere.
Oh, does it? In the break, I just popped through to my girlfriend and she said that there's a bloke next door sunbathing topless in the garden. It was only about 10:15 at this point, so it must be quite nice outside. So I'll try not to keep you too long. So I'm going to assume everyone's listened to the first episode, but if you've not, it just talks about Ben's history in investing and his philosophy. I would recommend it. I'd probably recommend going back and doing it before this episode if you've not already done it. If you don't want to, that's fine. If you enjoy this episode, you can maybe go back at the end. And if you just want to listen to this one in isolation, that's fine as well. So, Ben, I'll jump straight back in. What are your thoughts on current valuations in the US?
Generally speaking, I'm a bit of a bear on the market, or probably a bit more than a bear. No one likes to hang around with bears. But if you look at I've always been quite data driven. Once some of that, I guess, with parts of my portfolio. But if you look at the actual raw numbers of the Schiller PE, 29 or so I think this week, and the normal PEs in the mid-20s, and whatever kind of standard measures of valuation for an index or a market, it looks pretty frothy. And I'm a big fan of kind of mean reversion and historical trends. And I know we had a big drop off in 2022, and we've kind of bounced back through that. But I think overall, when kind of markets tend to mean revert and fall, and I do think there's probably maybe a trend where prices and multiples are going upwards, but I just don't see us kicking off a new bull market or moving on from here. My biggest concern really is it's not the high multiples, which I think are fairly evident. My biggest concern with the US market now is the concentration risk that's become evident. And what I mean by that is, you look, I think it's the top seven or so companies, so obviously the Apples and Microsofts, and you've got the Teslas and all that. They now make up such a high proportion of the market cap of the index. I think best part 25%. So what you've had is a lot of active money kind of flow into that. I mean, those percentages weren't that high a few years ago, and if you take away, if you look at the PE of the S&P 500 as the proxy for the US market, if you take away those 7 companies, since we've had this sell-off, we started at the beginning of last year, kind of back away those 7 firms, the market PE and market multiples have dropped, or they're consistent or fell flat. And it's actually those 7 firms that are kind of dragging the rest of the market in terms of performance and the multiples. And so the concentration risk there for me is just a bit of a house of cards. And I think it's propping up that market. And no one likes a macro forecaster. And we talked about books in the first episode. Every book you read says don't be macro guy, don't focus on the markets. But it is all inherently linked to some extent, and interest rates and so on and so forth. But I look at that concentration risk now and just think if there's a straw that breaks the camel's back or some kind of catalyst in those 7 companies, there's so much weight of the market and concentration risk that it might just be a bit of a house of cards. So that's my somewhat tin hat kind of theory on the whole thing. And as I found, if something happens to those companies, the active money. So you've got the passive flows, active flows. The active flows is what really steers the market kind of will go into if we have a big crash, in my opinion, because the passive funds they don't affect the concentration. They just go every month, the market cap weighted. They'll just go to whatever the kind of actives it tends to steer them to. If that active money, which in my opinion has flocked to those big 7 names in the last kind of year or so, if they get triggered or whatever happens, I just think we're in for a bit of a crash. And I still think that because I look at the Schiller PE, I look at the numbers, they're above the long term averages, and when we look at mean reversion, things go above the mean, things go below the mean. It's very uncommon, if you look at history, that things just kind of have a soft landing back towards the mean, and the mean's the mean because it's the midpoint. And I think we'll underswing it. So I'm still a bear. I've got a couple of short positions. I could be wrong. I probably will be wrong. Bears always get it wrong. But I think it's a very frothy market, and I think as a market as a whole, it's overvalued. But that's I'm not an index fund buyer, so to speak, so it doesn't necessarily rule out companies in the US. There's plenty in the S&P 500 that are tempted by the broader small caps. So, but that's my general market thoughts anyway.
Have you given much thought to, rather than a big pullback, you could just have a period of basically stagflation, in terms of you might just have, like, for example, like another lost decade where you don't have a pullback, but nothing really moves, and it gives the company's earnings a chance to catch up with the multiples.
Yeah, no, I completely agree. I completely agree. That's totally on the cards. I forget the chap's name. There's a book called Sideways Markets. I think the same author's written similar stuff to that effect. That, yeah, definitely what you're describing. I think it's what we've got that ahead anyway. I think for the next decade, look at the valuations. So I guess the reason why I think it's still got the big bear and the one big final swan song down, in my opinion, is because of that concentration. I mean, if you look at companies that are now kind of trillions in market cap and the PE, what they are, I mean, we'll come on to NVIDIA probably at some point, but NVIDIA's now the best part of 700 billion, trading at a PE of like, I don't know, 180 or something, and the price to sales of God knows what. And that is, your point about earnings catching up with prices. I mean, there'll be some exercise for that to happen, and I think the same with the likes of Tesla and whatnot. And yeah, I don't know. I think interest rates have gone up, and I'm just going to sound like another macro forecast that always gets it wrong. But those things have a bit of a lag, and us, I think we're kind of frothing about sideways at the moment. I think we've got one final swan song, but as you say, you could be right, I could be wrong. Who knows? I've certainly been burnt on the video short so far to date, so hopefully I'm not wrong for too much longer. But yeah. But in short, I think it's definitely a frothy market.
So in contrast to that, what do you think of valuations in the UK?
I think this is generally fine. I don't overly kind of study them as the US tends to, rightly or wrongly, be a bit of a proxy for the world markets, given its size. Everything in the UK looks fairly okay. Obviously there's pockets in it that are good, pockets in the that are bad. I don't think there's I don't have a great deal of commentary on it, to be quite frank. I think the thing I've noticed more is the phrase, the kind of value spread. So the actual spread between the most expensive in the market and the cheapest in the market, that universally seems to be quite large at the moment, which, again, not to be overly quantum data driven, could be a good sign if you shop them in the lower regions from a valuation perspective. But no, the UK is generally fine. It's just got a lot of companies that are historic, but that's probably where the value is to be made. How many times have kind of Warren and Co said, buy boring, all that kind of stuff. But yes, so I think the UK is fine. It's about in line with the long-term averages, I think.
How much of your time is spent looking at US companies versus UK companies then?
I think naturally, just because of the size of the market, the time I probably look at it probably just reflects the weighting really of what it is in the world. I guess the amount of information and chatter and when you look at screeners or conversations on Twitter, there's just so much more going on in the US markets, which is a fault of my own, really. We should try to avoid going where the crowds are going. But I'd say it's give or take probably 50-50. Naturally, I shouldn't even be looking at the UK as much as I do. I've probably got an element of home bias, but sometimes it's easier to understand what's here in the UK and try not to think too much about currency risk, but you've got that factor as well. So yeah, it's probably about 50-50. I think my portfolio is more weighted US, but that's just coincidence rather than any deliberate action, I think.
I don't think there's anything wrong with 50-50 time on it, because I just think if you look at the UK, in terms of the regulations and the accounting standards and stuff, it's pretty similar to the US in that it's a very favourable environment. You can read an annual report that's been signed off by the auditors, and you know it's going to be pretty reliable. And then on top of that, like you say, the reality is that your day-to-day spending is in sterling, whether you like it or not. So if you just have everything in US dollars, you could do well on the stocks, and over a few years, you could get hammered on the exchange rates. I know it can work the other way as well. But then as well, like you say, you do, like, I don't know, just for example, like it's not a particularly good business, but if you want to take a look at investing in Currys, for example, you understand the business, you can go in the stores, you can go and have a look around. You don't really have that with the US. And I know you might be able to have a look at it online and get a pretty good feel for something like Best Buy. But equally, there's businesses in the UK where I just think if you're doing it as an overseas investor, it's much harder to understand. And that would apply to a lot of the US equivalents. So you've just got, I know you can't rely on it too much, but you do just have much more anecdotal evidence to rely on. So I personally think it's a mistake when people spend all the time focusing on the US. And we do get a lot of people on the podcast where they come on and they say, well, I just want to look at the US because that's where the best companies are. And it's hard to argue with that. But whether you like it or not, the companies might be better, but you are bringing in other risks that could be lessened by having a decent UK weighting. Whereas if your home market's like Zimbabwe or something, then fair enough, just look at the US. But I think the UK market is good enough that you should probably, I think most people should have a decent allocation to it. But you look at the US performance and it is hard to argue.
Yeah, no, I agree. The only point is that trying to look in places that are a bit more overlooked. As I said, the US is where all the eyes are. So I'm not exactly a believer in kind of efficient market theory, but it's probably that's where it's more prevalent than anywhere else in the world, I'd argue, just because of the amount of eyes on it. So the opportunities, if you kind of take a value approach, might be more difficult. But yeah, no, I agree. I just kind of don't have any particular strategy. I just kind of look around, things fall in your lap from all parts of the world.
But I think, like, as well, it's like you've also got the issue in the US where the valuations are just higher, and some of the companies are better. But if you don't mind doing a little looking around, I don't think it's always the case. So, like, as an example, in the US, I know Kraft Heinz is pretty cheap at the minute, but that's because it's had quite a few issues in the last few years. But if you look at a lot of like the consumer goods companies, like McCormick, it's like 35 times earnings. Coke and Pepsi, like 30 times earnings. If you go over to like the UK and Europe, Unilever's, I'll leave that out because it's had its own issues over the last few years. But if you go to Europe, Nestle, it's as good as any of those businesses. It's as well run. It's pretty expensive. It's at like 23, 24, something like that. But it is still cheaper than McCormick at 35. And I think Nestle stands up to any US consumer goods business. I think it's got a fantastic portfolio of brands. So I think if you don't mind like looking around, they might be harder to find, but I do think you can get just as good companies in some cases, and definitely not all cases, because we don't have anything that is even comparable to Apple or Amazon. But in some cases, you can get companies where their US equivalent would be trading at an extra 10 times, and there'd be an extra 10 on the PE ratio, and there's not really any reason other than it's listed in the US.
Yeah, no, I saw that. I didn't dive massively into the difference between operations, but I saw that historically with Domino's UK and Domino's US, massive price divergence, and thinking, well, that much pretty different about it. So no, I agree with everything you said, definitely.
So how do you think about allocation and position sizing?
In terms of my active kind of portfolio, half of it is kind of done on a kind of quite quantitative basis. So I kind of, in my head, have kind of broke it up into over the years, as I moved to do the kind of active stock picking more in a deeper value space. But I've gone there because I think that's where the great investors in history should hopefully provide the outside of returns, but we'll see. But I'm also trying to be fully aware, not too naive, of my own ability, and thinking that if I just go gunko and put all my assets and all my money into 100% my own stock selections, it could go horribly wrong. And I enjoy my job, but the whole point of this is to grow capital and maybe early retirement and whatnot. So 50% of my active portfolio, or give or take 50%, is into essentially a kind of quantitative approach, which is based on the acquirer's multiple, which again is back to my man crush, Toby Carlisle, and you probably saw, as all value investors have at some point, as part of the lure of why you get into value is the kind of historical studies, and there's hundreds out there that are quite empirical with where you buy low price to book, low price PE, or a composite of them or whatnot. And I got engrossed in all that kind of quantitative stuff over the years. I've read up on the quality factors or factor investing, a venture investor, and kind of concluded that what he coins the acquirer's multiple, which is essentially enterprise value over EBIT, has historically in the last 100 plus years been the best outperformer. It's had a tough time, as all value has for the last 10, 15 years, and again, history doesn't, just because it's happened in history doesn't mean it's going to happen in the future. And I know I'm aware of all that as well, so it's not a sure bet. So I kind of put half my allocation in that, which is a basket of stocks. I pair up the acquirer's multiple with the peer atrocity F score. If you've heard of that, it's a very quick and dirty checklist that essentially just check that basket of really cheap stuff, which is what it is. It's the lower decile. If you rank every stock in from start to finish, it's the lower decile, the lower 10%. And then I pair that with the F score, which is a quick checklist just to make sure that things like, is the company actually profitable? Is it got a return on assets? Is it actually not bankrupt? It's a quick checklist. It means that when you're fishing in that pond of the cheapest of the cheap, that you're actually just kind of a little hint or bit of quality in that basket as well. So the F score is a 9-point checklist to try and get a 7 or above, and then it goes into a little basket, and then I just rotate that basket. Bit like everyone's heard of the magic formula. That's the most famous quantitative approach. That's the green black magic formula. It's a bit like that basically, and just hold that basket for a year, flip it, and go on. And I do that basket diversified, kind of third US, third UK, third Europe. I'm not quite kind of big trust in the numbers that could come from certain parts of the world outside those three areas. So that's half the portfolio. And mentally then, that's my way of thinking. Well, that should hopefully perhaps outperform the market. The history says that should get upper teens in terms of performance. I'm not saying it will in the future, and there's lots of evidence to suggest that kind of stuff like that gets halved away. But I still don't think I should lag the market by that approach either. Like, if it doesn't work as well as it used to, I should like to think it's still not going to put me in a negative position or really put me in a bad position, just because the pure margin of safety you have by shopping the lowest decile is kind of inherent in selections. And then, again, apologies for waffling, but the second half of my portfolio is what I call kind of active. If that's a phrase that I can coin. And I tend to try and have about 10 positions. So if you then work that, extrapolate that to the larger portfolio, if my kind of quant-based acquirer's multiple takes half of my portfolio and I have 10 positions that are active, each active position is about 5%. Now that's very kind of rough. I've got some positions now that are in excess of 10%, either kind of through organically growing or because I've deployed more cost into them. So I'll happily put 15% at cost into a position, just because I feel that's still fairly diversified when you kind of count everything else. But generally speaking, 5% is usually my preferred. Just give me a nice equal weight of 10 positions taking up half the portfolio.
So how's that acquirer's multiple basket done, and how long have you been doing it for?
Yeah, so that's the annoying part for myself and for you in for the listeners. Is that's something that I've only really gone towards in the last year or so. I had a period of time, but as I said, I had a bit of an identity crisis over the last 2-3 years, where pivoting from quality to value, looking at things like magic formula and kind of messing around a bit and whatnot. So the jury's still out. I don't have a performance to track record. It's been in line. It's been a little bit better than the market over the last kind of year or so. It's probably kind of up a few percent at the moment versus I think the market's about flat, give or take. But no, unfortunately, there's not a track record. And my broader philosophy is to judge myself and everything on at least a 3-year basis, really. So we'll see.
So is that what the 41% in the active portfolio is then?
It is, yeah. At the time when I sent over the numbers to you a month or so ago, that's what the allocation size. But the target generally is to have that about 50%. Right. I tend to try and rebalance that.
How much time do you spend a month on investing in your portfolio?
I tend to try and do an hour or two a day, and if you extrapolate that to the month, 30 to 40 perhaps. As I mentioned earlier, working from home a lot more now. Try to kind of utilise that time in the morning, get an hour or two in the morning. Sometimes do, sometimes don't. Again, sometimes a little bit here and there on the evening and weekends. So all in all, it's probably average of, give or take, 10 hours a week, I'd say. So 30, 40, 50 a month.
What do you think of Bitcoin as an investment?
That's the old divisive question, I guess. It's not for me. It's maybe I'm just a bear in nature, but I think it's more likely to go down than up is my view. I caveat that I'm not kind of a technophobe. I mean, I was I had the unfortunate, maybe I think I've been stung by it as well. I had the fortunate case of being into Bitcoin extremely early. I've been on the beach somewhere, but I mean, I was in Bitcoin very early and just kind of rode the first few hype trains many, many years ago, kind of 10x my money. And then greed got the better of me and looked back to where I started. And that was just about 7, 8, 9 years ago. And I've learned more about investing since then. I think I don't want to offend people who are into it because I know it's quite an emotive subject, but I just think it has too many traits that are kind of linked to things that have not worked in the past. So I think it's too much of that great fall theory for me. It's too many people that are using it as a get rich quick kind of approach. I'm not really sure how future proof it is in terms of the end of the day, it's kind of software ecosystem and what will IT and software be in 50 years, 100 years? There's bugs, weaknesses, issues to iron out. I'm pretty sure, I'm pretty sure a bar of gold is going to be a bar of gold in 1,000 years. Bitcoin, I don't know. And I think it's just too many things that I'm, it goes into that too hard hole. There's too many things I can think of that I'm just not sure. And yeah, I think it's just, I can't really stick a value on it. It would be, for me, it's just no concept of margin of safety and all that kind of stuff. So I don't I don't wish bad luck on anyone. I think when we spoke before, Sam, you've got to kind of apportion aside into it. So I could be wrong, but I just think it's probably more a no than a yes for me.
You don't think that asteroid mining is going to ruin the gold price?
I have no idea what that stuff is. I have no idea. I mean, I think even gold, people who hold gold aren't holding gold to kind of, they do it to kind of keep up with inflation. If you look at the historic price of gold, it just keeps in line with inflation. It's not something for growing your assets. I think people hold it as in that manner, as a kind of store of wealth, but is in kind of flat store of wealth. I think people are the Bitcoin approach is really to get rich. I'm not sure
with gold though, that's mainly because for the last 5,000 years or however long we've been using it, we've only been able to increase the available supply each year by probably a couple of percent. If we were to actually start mining asteroids, the amount of gold we'd be able to then start bringing back to Earth, it would be about as valueless as diamonds. But then you get into all sorts of, I mean, firstly, it might not happen. Secondly, it might not happen in our lifetimes. But then as well, you do get, I think it's also possible that because it doesn't have that much industry, like loads of industrial uses, although I'm not sure if that's just because it's so expensive, would you just get, people could just restrict the supply, kind of like with diamonds, they're pretty worthless, but you still have to pay through the nose because the supply is restricted. So it might not change anything, even if it does work, but not really relevant.
No, I've got no view on gold really, or not educated enough on gold and all that stuff. I think I wouldn't put forward an investment case for gold either. So it's not like I'm saying we don't need Bitcoin but gold. Neither for me. I think we'll see how it pans out. It's a space as well that's got too many toxic people, too many things going on that I just don't like. And, maybe I'm getting old, but I just stay away from it.
Why is your SIP entirely country-specific ETFs for emerging market countries?
So the fact they're emerging markets is a coincidence. My SIP, again, I took a bit of a quantitative approach, having gone through a hoard of books in the last kind of 5-6 years, just as much as kind of assessing, the importance of the fundamentals of stocks. There's so much about markets to be said about kind of human beings and our behaviours and things that overact on the upside and overact on the downside, kind of mean reversion and all that kind of stuff. So it's essentially, I've read several books and it was inspired by Irrational Exuberance, which is one of Schiller's books originally, and then I've looked at other studies. Basically, I've looked at what are the worst performing markets over the last 3 to 5 years, and then just put my assets put my allocation into them. Just again, history doesn't mean it's going to repeat itself, and there's all that caveats. So plenty of listeners screaming at the podcast. History has shown that the best performers over the last 3, 4, 5 years, so in this case, the Nasdaq, the S&P, those markets then tend to mean revert and, for the following 5 years, not do very well. And the same is on the upside. So I looked at various kind of tools and trackers where it's really not performed well over the last 3 to 5 years. There were some markets that I couldn't get access to, but from the ones I could get access to, I thought I'd kind of take a basket approach. again, it's a bit like this is all stuff that I kind of did over the last couple of years. So again, the jury's your leading question will be how's that worked out for you, which I don't have an answer as much. I think I'm about 18 months into that. It has outperformed, but I don't think 18 months is a big enough sample. But yeah, that's the approach in general.
Do you not think with that approach though, you're then bringing in so much country specific risk? So those stock markets could have underperformed. And it's more to do with like the governance, for example. So I know you've probably not been able to get access to it, but I imagine if you had been able to, I imagine Russia's done pretty poorly. But because of the political situation, you wouldn't want your money in there. So are you looking at the political situation in these countries and as to why the poor performance has come about? Or is it just a pure basket approach?
It's a pure basket approach. I agree with everything you said, and I'd never do. I never just pick the worst of the last and just do it all into one country. And you could argue that five is probably not diversified enough. But it's not. I would never go gung ho and do 100% of everything into this. And I guess people could argue you shouldn't invest in stuff that you not comfortable do with all your money. But I'm just looking at the data. I just felt a kind of reasonable sense of confidence it might be a strategy that works. Yeah, you're right. There's risk. I think the plan hopefully is that if there's a basket of these, a couple of them like all deep value kind of strategies might go to zero and absolutely blow up, as you say. You've got things like Russia and whatnot, but the others that have been beaten down so hard, the psychological elements of them being beaten down so hard means hopefully the only way is up. And there's plenty of investors who said that and got it wrong, but we'll see.
But there could be some of those where if you just did like a little bit of looking into the political situation, you'd see like, for example, maybe one of them's like got a dictatorship that's just come in and they started nationalising everything and not paying the investors for it. And that's why they've tanked. And if you did that, there might be two or three that you end up ruling out, and you could end up doing the same thing. And you might have some companies that are slightly higher up, but it's of the 5 companies at the time of investment. From the limited information I have, I'm fairly comfortable with the political situation and the regulatory situation. So you are eliminating some of that risk. Whereas for some of them, it's kind of like some of the cheapest stocks. When you're looking in the lowest decile and you're not filtering it by quality, you do get into the point where some of these are cheap for a reason.
Yeah, but I guess my thesis is playing against humans rather than the countries or the stocks, if that makes sense. And for all the reasons you've outlined is why people may not invest in them and they'll avoid them, and that then drives the price down. And so that's what as I said in the first session, it doesn't matter how bad something is. There's a price for it that's worth it in terms of asymmetrical upside, and so the more risk and the more problems and the more regulatory or all that kind of stuff is actually that's part of the thesis, because that's why it's in the dregs, and hopefully can swing back the other way. Yeah, in hindsight, I should perhaps kind of get the basket bigger, move it to 10 countries rather than 5. But I just look at all the studies and the empirical stuff, and just quite standard stuff I've seen and read into it more, and yeah, so. But we'll see. I couldn't actually genuinely give you much of a thesis on each country individually. It's just more a basket approach.
We'll have to get you back on in a few years' time, because I'm very curious to see how this one works out, actually.
Yeah, but
you might come back on in a few years and look like an absolute genius.
Yeah, I mean, the thing is as well, like, it's like empirically value investing has been shown to outperform the last 150 years or whatever that goes back to.
Yeah, and there is. I'm playing devil's advocate slightly, but there is arguments for both sides, because, like you say, if you just do it empirically, you are taking all the human biases out of it as well. You might, if you were to go through and actually look at them, you might not end up investing in any. And like you say, some of them will do well, which is why you do the basket approach. But what do you think the return? Have you looked at all what you think the returns would be in terms of would it be? They're not all going to go up. So are you going to end up with some that just tank, and you might have one that's up hundreds of %, which I know you wouldn't normally get in like an entire country, but is that more what you'd be looking at with that sort of thing? Or would almost like a venture capital thing where you might have 4 or 5 that just tank? If you were to do 10, you might have 2 that just absolutely turn it around.
I look at it as a collective basket. So I've actually done this basket on a 3-year process. So whatever the combined value is of those 5 countries ETFs in 3 years' time, I will sell them all at the 3-year mark, and then I'll then go by the new batch of 5. So there'll be kind of this combined pot of money. Now, 4 of them gone to zero, and one of them's fivefold or whatever that pot of money is, will be rolled over to the next 3 years and the 3 years after that and so on. I'd actually prefer to do it on a 5-year basis, but I struggled to get 5-year data for all the markets, and I was judging what I was looking at, the data and the back tests and all that empirical stuff, that 3 years still would work. Ideally, I want to try and do 5 years when I come to refreshing it. And I think a lot of it, Sam, I think, is just because we're about the same age. We can't touch this till 57. It might even be in our 60s. And so it was a kind of somewhat quantitative experiment that I just thought, I'm going to keep rolling this over the years. We have good years and bad years, and we'll see what we get to. But the point I was making about value investing, about the 100 years of data, thing is, value investing's had about 15 years, 20 years. So I could easily get a 20-year patch where good strategy and it just fails, or vice versa. It could be an awful strategy. I'm an absolute idiot for doing it, but I make a load of money. So we'll see. I'm confident in the data, but I'm also not, naively overconfident. So we'll see.
You view so you've got your SIP, you've got your workplace pension, and presumably you've got like LISAs and ISAs. Do you view it all as one portfolio?
Not as much as I should, if I'm honest. I kind of do. I take stock once a year and kind of almost like do a full assessment and kind of benchmark where I'm at, where I want to be and stuff. A lot more time and effort. I think the problem is I was getting a bit pulled left, right, and centre, trying to use it all as one big portfolio, just using up too much brain power. So that's why the SIP and the workplace pension now has just become a set and forget, and therefore. Yeah, of course. Once I include it in my whole, I do include it. So maybe I'm going back on what I said. I do include it as one big portfolio. When I project where I want to be in the future and stuff, I can do all as one. But I guess in terms of brain power, 95%, because of all the active stuff that we've talked about. The pension was deliberately set and forget just because there's only so much brain power I can put towards those things.
That's fair enough. So my workplace pension. So I've got my workplace pension. I've got my LISA and ISA, and then I've got like a little bit of Bitcoin that goes in every month. So I've just got the Bitcoin's just £52 a week, and I don't need to think about that. The pension, that's just set in 5 different index funds, but it's rather than it's trying to do a world market, but I don't want a 50% US weighting. So what I've done is it's 5 different index funds. The idea is to try and replicate it, but with more equal geographic weighting. So it's 20% North America, 20% developed Europe excluding UK, 20% UK, 20% emerging markets, and 20% Asia Pacific, with the idea being that if you just project out what you think that'll do, so maybe I don't think it's unreasonable to think it will do 7% a year, 6% after fees, just because the problem with the workplace pension is you can get the really low index funds, but the provider still hits you with like a 1% fee in mine every year. Yeah. I might move it at some point, but...
If you look at, everything you just said, I completely agree with. I've kind of set up my family members' allocations to do exactly that, rather than just all be weighted towards the market cap of the S&P. And if you look at, again, and I sound like a proper quant nerd, if you look at the studies, the actual non-market weighted distributions in any markets, whether it's just S&P 500 on its own or global, does outperform. So it should be the smart thing to do.
Even if it doesn't, you're talking about the difference of like, it's still going to do well. Over 40 years. So maybe you could have got an extra % a year if you'd done the world index with the actual weightings. But you're going to do well enough that I think if you're more comfortable with it, it's just a no-brainer.
Yeah, I think Joel Greenblatt's latest book that no one ever talks about, and I think no one's ever read. That's his strategy, that you go the equal weighted rather than market cap weighted. With you on this podcast, I'm not trying to interview you. I'm just curious.
No, it's fine. You can ask away.
In terms of the LISA, if you don't mind me asking, is that for retirement or for property?
So I don't own a property. I'm in a bit of a funny position where I could go out and buy a house if I wanted to, not outright, but I could still get at the LISA for the deposit. I'm now at a point where I've got enough in there to do that, and that is originally what I set it up for. But I think when I do, the issue is I've got at the minute is I'm living in Darlington, which is fine, and I work in North Allerton, but there's a reasonable chance I go somewhere else in the next couple of years. Like I'm not married to Darlington as an area. it's fine, but as long as I stay around like the Yorkshire North East area, I'm fairly happy. So I don't want to buy a house now even though they are quite cheap in Darlington, in 2 years' time decides, for example, I want to move to Leeds or Newcastle, and think, well, what the property market's gone down in those 2 years. I'm in negative equity. And I'm just sat there thinking, what did I buy a house in Darlington for? Just because a lot of people are always just obsessed with like, well, why haven't you, like, there is an obsession with people like to get up in the property market. And it's like, well, if you're not going to be there for at least 5 years, I just think it's stupid. So I set up the LISA with that in mind. But now I'm probably at a point where, because I've waited so long before buying a house, because I'm 28 in July and I still don't have one. And I'm in the fortunate position where like my investing's done well and I've got a decent job. So I've got other like pots I could access. I sort of quite like the idea of not using it for the house, getting the 25% free every year, and just letting it compound until I'm 60. Because it's not like a SIP in that you can still get at it. You just basically just lose the tax-free bonus. And because you can only put $4,000 a year in, it's quite easy to max out. So it's not like you're never going to have a pot, because presumably once you max it out, or once I max it out, I then move on to the ISA, which I can always access whenever I want. So yeah, I think if I were to buy a house, my plan is, what I'm hoping will happen is that the Bitcoin price would be such that I just sell the Bitcoin and that's the deposit. I know it's quite a risky strategy, but I would stress that I'm in the position where if Bitcoin tanks, I'm not dependent on that. Yeah. It would just be nice if we got that one more bull market or something and it was up 200 or 300%, I'd probably just cash out and be like, that's my house deposit now. So that's sort of where I'm at with it. But I view it all as like one pot. So I've got the pension with the index funds. And the idea is that even if everything else I do is a zero, I make sure I'm putting enough into the workplace pension. And if it compounds at 6% after fees, that my retirement is still going to be very comfortable. And then if everything else is a zero, which I would hope it isn't, I'm still fine. But then, yeah, so I do the workplace pension. I do the £52 a week in Bitcoin. I do the ISA, and then anything spare goes into the ISA. So that's what I do with it.
So the 52, is that something?
Yeah. So I think I could get the fees lower, but I use Coinbase just because it's so easy and it's just a direct debit out of my bank account every week. And I don't need to think about it and whether the price is low or high, although I only set it up about a year and a half ago. So far I've been buying it when it's pretty low compared to the peak. But what happens is when you buy it, I think if you're between 50 and £50, they charge you like £1.99. And then I think if you're between, but that includes, so it's like £51.99 I invest, because that's the maximum you can get at £1.99 of fees. And if you go above the 50, the fees then jump to like £2.99, but it's 50 to 200. So if you do 200, obviously it works out at a lower average cost, but I don't want to be investing 200 quid a week in Bitcoin. So it basically minimizes the average fee, because it stops me going into the next price bracket of how much they charge me. So that's where the 52 comes from.
Yeah, that makes sense. I remember, so I was in the crypto space a while back, and that's why I'm probably bit of it. I'm one of the only few that come out of it not very well, but because I've always been tight and really annoyed by all those fees, I went through the rigmarole of doing it through a European bank and like literally moving the money, transferring it through the FX for the bank, and then moving it from a European bank onto direct to the exchanges rather than going through Coinbase. I can't even remember the name of the exchanges now. It's like so long ago. Because what I think what you've effectively outlined is that the £2 fee on £50, it's 4%, isn't it? 4% fee.
Yeah, it's high.
So I just couldn't. I remember doing it. I just couldn't stomach that. But it's ridiculous because the whole thing will move 15% in a day. So
yeah, that's how I rationalise it. It's so volatile that what's 4%? If you bought it an hour ago, you might have paid 4% more.
Yeah. So I was irrationally tight and frugal about how I went about it. But I used to have the right faff of moving the money about and stuff. And then, it was in all those alt coins and all sorts and stuff. But it was I just couldn't have played it any worse. I honestly couldn't. So but no, honestly, best of luck.
I was the same with it. So I first got into it in like 2016, 2017. It was before that big run up, and I put a few grand in, and I think I rode it up to like 25 grand or something like that. And then when I sat there at the top in like January 2017 or whatever it was, I was just like, nah, this isn't a bubble. All these crappy altcoins are going to change the world. And I rode them all the way up, like 10x my money in a few months or whatever it was. And then I rode it all the way back down. I was all right. I managed to get out about what I'd put in, but then, you hear some of the other stories. Like I know a guy, and he put 30 grand in, rode it up to 300 grand and started like playing with margin and stuff. Did a short on Bitcoin on margin, the full 300 grand, and just got liquidated, and he lost it all overnight. Next day he goes out and puts like another 30 grand in that he's had to like borrow from every source he can, and turns that into $1 million. You do get these stories, but I've not done that. But now it's just, I don't. The more I learned about it, the more I was uncomfortable with like basically everything that wasn't Bitcoin. So now I just like to buy a little bit of it every week. And the idea is I view it as like an alternative form of saving. Whether it works or not, I don't know. But at 52 quid a week, I don't really notice it that much. So we'll see.
Yeah, definitely agree. If you're going to do it Bitcoin. Yeah, definitely.
So why did you decide to sell Games Workshop?
I've always been a long-term fan. Great company for all the reasons you mentioned on the show. And really quite like the CEO as well. Kevin, what's his face? Always followed it and kind of had a passive bits and bobs, small amount. It come to that point last year where there's been a market sell-off and it dropped into like mid-teens PE, and it's just where I was having kind of identity crisis, not knowing what I wanted and what I was investing in. Let's just essentially just took a swing at it down, put a good meaty position in. And as the market recovered, and then you had the Amazon pop, I think I was up about 50-60% in about 6 months. And I was like, sitting there kind of with my approach as it is now, it's evolved to just thinking this thing is priced in the high 20s on a multiple basis. And I just looking at great company, but just not seeing where the next decade of kind of outperformance would come from versus the market. And don't get me wrong, it's outperformed the market for the last, 10, 15, 20 years. So I'm not, I just feel like it just was not, it was not a sure bet to get much of an outperformance, and it was, it was probably do very well. And as I say, if I'm in my 50s and I'm holding a basket of quality stocks, it'd be a great part of that portfolio. But trying to get outsized returns, I just couldn't see much through in the portfolio. It's some anecdotal stuff as well, really. I think, as we touched on earlier, maybe I'm a bit wrong with the prices, but I've got a few friends that play that they kind of do give the hint that the companies, I don't want to say fleecing them, that's a strong word, but there's always a lot of changes in terms of the rules, a lot of things are moving, and it's getting harder and harder for people to join at kind of a youthful level, or the barriers to entry in terms of playing is quite difficult. And that kind of just theory grew in my head that actually, like, if you don't look after the future customers or bring them in, then I don't know, there's just one or two things that were seeding or putting the seeds of doubt in my mind. And when you coupled it with a PE that was like high 20s at the time, and had that pop from Amazon, and I just, it was a great company, but thought I'd move it out. I'll probably be kind of proved wrong. It's still a great company. I think there's nothing wrong with holding it. It'll be here in 20 years. It'll be doing well. I haven't looked into the Amazon stuff, to be honest, in the last 6 months, so I don't know what's going on there. But again, if it propels, and as you know, not saying it's going to be the next Marvel, but you never know, it could really go on here and rock it. But that was it, really.
What's the thinking behind the tech shorts that you've got in your portfolio? So at the time you sent the question list over, you had Tesla, Apple, and Nvidia, all as shorts.
Yeah, so we'll have to see how it plays out. But I think once every 15 to 20 years, the market just gets in a rational position. And everyone looks back at hindsight, it's blooming obvious. The nifty 50s, as people talk back in the day. You also had the tech bubble. And I'm just sitting around in 21, 22, looking at all those valuations and thinking, I know they say the market can stay rational longer than you can stay sovereign, and I'm fully aware of that. But some of those valuations, particularly Tesla and Nvidia has been more of a recent entry. I look at the PE of 180, I think, is on Nvidia, price of 30. And if you saw that knocking about a 10 billion kind of market cap or something, then you can go up and down the volatility. But this thing is, it's getting, every week I look at it now, it's getting closer and closer to a trillion market cap, and 180 PE, best part of getting towards a trillion market cap. I'm a value investor is basically finding things cheap and riding the upside. But, I've seen value really on an incredible sense of gravity on those things. It's not quite a basket approach, but I've kind of, you'll see from the allocation sizes, they're not massive. They are. I've also kind of put them as kind of in my mind as one short position. So they're kind of three of them as a basket of three in terms of the short part of the portfolio. As a three, they're in the green, so to speak. But yeah, you look at this market, and I'm looking at this Nvidia now going up literally. It's growing in like almost like a year's worth of revenue today in terms of market cap. It's bonkers, and history littered with shorts that got burned and on the streets, so to speak. So we'll see. But I just couldn't look at these valuations and think there's not some downside and not a position that worth taking, to be honest.
I agree with the logic on the valuation. My issue with them is I've never shorted anything. I've never read anything about shorting that's made me think I want to do it, just because what I don't like about it is, like, I think if you buy a quality company, if you're right on absolutely everything except the timing, you can sort of wait it out.
Yeah.
Whereas with a short, you can't do that. You've got to be right on the timing as well. And the problem is, like you say, the market can stay rational longer than you can stay solvent. And I just think if you look up Apple, not so much, but if you look at Tesla and Nvidia and go back 3 or 5 years, you probably could have made a lot of the same arguments. Like, people have been shorting Tesla for probably 10 years.
Yeah, like you're completely right, and that's the little grim reaper that's on my shoulder. People have been, bearish on the S&P 500, for decades, haven't they? And 2018, 2019, obviously we had the crash with COVID, and it's carried on. I don't know. I feel like it's once every 20 years it gets so exuberant that it's just somewhat hits you in the face, and that's why I've gone for it. You are right though that it's a kind of toxic way of investing, and it's the first time I've ever shorted anything, and I hope it's going to be the last. Perhaps if there's frothy valuations like this again in 15, 20 years' time, when we kind of go through another cycle of crazy exuberance. But I'm going to be at a point in my life there where I don't want the stomach ulcers, and I probably hope we got the capital that I'm more about preservation, quality and whatnot. So yeah, I agree with everything you said. I would never go gung ho. The combined 3 shorts are less than 5%, and I've mentally put a bit of a stop loss in my head because I'm not going to chase it, to the moon. So they're in the green between the 3 of them, largely from Tesla. I'm just going to again put a look on the timing where I called that last year, but we'll see. We'll see. I think if they say that the start of the bear market is when the last bear rolls over, so it'll probably keep going up, and all those bears will give in, and then eventually the market will crash, and we'll be sitting there. But we'll see.
Yeah, like I say, I find it difficult because, like, with Nvidia at 180 PE and the size of it, it's obviously overvalued. Everyone could see that it's overvalued, but that doesn't mean it's going to go down in the next 12 months. And that is my underlying issue with shorting.
Yeah, I guess if we knew it'd be an easy game, so who knows? But the concentration of that top 7 is unheard of, and I think it's a house of cards. But we'll see. Yeah, I don't know. None of us know.
So what do you think of Alibaba as an investment, and why do you like it?
So you probably see a bit of a theme in my investing is kind of trying to there's the psychological elements of going where there's overreaction on the upside, the downside. And I think there's the fear and overreaction of Alibaba's what got my attention a couple of years ago. I've been in the stock quite a few years. Truthfully, I got into the stock quite a long time ago, and it was something I wouldn't like to do these days, which was just kind of getting a bit too much in terms of copying. You had the likes of Charlie Munger in it. There was a lot of. It was almost like it was the most talked about stock that was kind of down and out, so to speak. But one that people see amongst the value community seems to be interested in getting into. So the more I learned and got into it, I just see there's a bit of a, to use a metaphor, a bit of an underwater balloon. It's humongous over there, and China's had all these problems in terms of the market and the closure. But if you look at what it is, I'm quite put in the category as a growth company anymore. But it's like a growth company. It's got positive income. It's got positive cash flow. And if you look at the yields when you normalise all that, I just think it's a bit of an underwater balloon that should come back. Now, for all the reasons you mentioned earlier, regulatory kind of China, etc. I think that's what's pushing it into the value it is. But yeah, I think I've got confidence in the balance sheet. They've started now. I mean, the 10Q rather come out this week. I haven't actually looked at it yet. But for me, the signs are there that it's something I'm comfortable with. It's been in the portfolio a while. Happy with the size of it, happy with the average price. They're now looking to break up the company, which is a good sign that the management might initiate the catalyst. The buybacks are there. If they break up the cloud, the retail, I think that's shareholder friendly overall. Market still doesn't seem to agree. We're still getting a bit battered around this week. I haven't read the 10Q. Just in a nutshell, I mean, call it the Chinese Amazon. That's what was the one line that got me into it, and I think just looking at the numbers, I'm pretty confident, but we'll see.
Why do you like SCS as an investment?
So this one is kind of inspired by your old school kind of Benjamin Graham kind of net type stuff. I think most people are familiar with SDS, DFS, that kind of stuff in the UK. But the one liner is essentially they've got more cash in the bank than the market cap. The market cap's a nudge over 50 million. Got a best part of about 70 odd million bank in cash.
Do they have any debt?
No debt. From an accounting perspective, there's debt on there. So they don't show up on the screen as because the debt is the operating leases, which are kind of manageable, controllable on suitable time frames. And obviously, this classic case could be about. It's not. I mean, it's plodding along in terms of revenue and growth at fairly flat. It has survived a recession before. It's been around for over 100 years. But if you look at the management, seem to be very humble, normal, nice people. They're paying a whopping. They initiated 7 or 8 million in buybacks, which if you think, that's the size of the market cap. That's it's a good yield in terms of buyback yield. They're paying out like 7-8% dividend, and then if you look at a free cash flow. If you look at it on any metric, whether you're looking at free cash flow yield, it's ridiculous high teens, 20s. If you look at it on a PE basis, it's right down there, both versus its peers. It's below its peers, DFS, etc., and it's below its own historical trend as well. I think you're fishing in the net space, and people can. There's part of that cash is deposits and whatnot, but I think the amount of cash in the bank, the amount that the stock's paying in terms of the yield and the buybacks, was something I entered in a while back, stumbled across, and fairly happy. Yeah, so we'll see. I think it's obviously like all retail and anything in the UK. There's what bumpy headwinds are ahead in terms of recession, but you get a warm fuzzy feeling by that margin of safety from all the cash. The fact that we've survived a recession before. I don't know how true it is. I don't know if it's correct today, but obviously Michael Burry from The Big Short. It's never a reason to invest because someone else has invested. But there's rumours or he used to have a position in it as well. So that's always kind of someone who kind of aligns to you from a style approach. Practically he holds a position we're used to, because it's so small, you can't see it in his records. But so yeah, that's in a nutshell. We'll see. Yeah, I like that one. A bit like you said earlier about the anecdotal stuff. I'm less than 10 minutes away from an SCS. You can walk around, you can see the shops. It seems fine to me. It's not, it's not the next Google, but it sells sofas. It looks all right.
Be interested to know in its 100-year history how many of those years it had a sale on.
These DFS that the ones that are always famous for the sales. Yeah, I think you've got. It's hard to always find comparables. You've got DFS, you've got Dunelm next. Obviously, next is a bit of its own beast.
Yeah, but Dunelm and Next.
No, exactly.
I've never looked at SCS, but Dunelm and Next are both quality businesses, and I'm not sure if I were to look at SCS that it would be. I could be wrong.
No, I agree. So, sorry, I'll rephrase that. I'm not from a relative basis. The PEs against each other. As I said, there's not too many direct comparisons. DFS is the closest one, and then you've got some that are like Dunelm and Next because they're self-social, but no, you shouldn't be putting them side by side.
What's the Hang Seng Tech ETF, and why do you like that?
So it's essentially what you'd call like the Nasdaq of China or Hong Kong. It's positioned in Hong Kong for kind of the setup reasons. It was a part of the portfolio that was playing on the fear and the kind of overreaction to some of the market stuff in that region of the last 18 months. I tend to kind of got it, for example, with regional banks in the US at the moment. You had it perhaps Facebook 12 months ago, where whenever there's kind of like screaming noise and a negativity, from investors I've read up about and looking at the past, it's kind of really perks my ears up and I like going there. So yeah, it's the Nasdaq of that region. On a valuation perspective, it's more favourable than looking at say the US Nasdaq, and I think there's a lot of companies in there that the main ones I've heard of: Tencent, Barber, JD. I'll be very honest and say the rest of them I haven't really heard of, but it's kind of that basket approach. Not that the size of an index drop is a good enough reason, because that's you had a relative drop of about 70-75%, and obviously it's still going to be a long way to go. You need to measure it on an absolute basis, but yeah, I looked at that, and again I paired it as a position size with MSCI China, just because I think the Hang Seng Tech's probably a bit more volatile and a bit more risk kind of to it than just the pure play China. So I paired them as they're separate. They're paired basically, a bit like how I paired the shorts. So that's the kind of the approach. It's in the green, and then the fear really struck. Was it 6 months ago? had a nice bounce, doing okay in the green. Kind of, I try and hold stuff for 2 years, if I'm honest. I try to impose some rules sometimes to try and not sell too soon. So happy with that, kind of content. Don't really look at it, and we'll see in probably 18 months from now.
So that's the end of question list. Before I wrap it up, do you have anything else that you'd like to add?
No, I don't think so. Only an apology to you and the listeners. I think we've used up a decent chunk of time, so I have a tendency to waffle and go off on tangents. So, nothing to add. As I say, I'm not haven't been particularly active on Twitter, but I think, as we've mentioned, I've done this in isolation quite a lot over the last 8-9 years. So, yeah, happy to kind of get more involved on Twitter, questions, meetups. Hopefully see yourself again, Sam, at Funsmith, if not sooner. But yeah, no, it's been great. Nothing else from me. Thank you very much.
Right. Well, in that case, thank you very much for your time. I've really enjoyed it, so hopefully the listeners will too. But if not, I've enjoyed it anyway, so it was still worth it. If you do want to follow Ben on Twitter or ask him any questions, or if you've enjoyed the interview, you can find him at value_1pages. And that's one page is all as one word, ONEPAGERS. So that's value_1pages. Or if you're being lazy, you can just look down my follow list and you'll find him in there. So thank you again very much for your time. And if that's everything, then thank you very much for listening, everyone. And we'll see you all next week.
Super. Cheers, Sam.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.